Welcome to Business Day's half-hour special on high-frequency trading. The controversy over HFT continues to build. In the aftermath of Michael Lewis's latest book, Flash Boys, European lawmakers are looking to crack down on high-frequency trading. This follows the U.S. Securities and Exchange Commission announcing that it is reviewing the practice. But how does it impact you, the individual investor, and does it mean that the markets are rigged? We're taking an in-depth look, and we begin with Diana Avigdor. She's Vice President, Portfolio Manager, and Head of Trading at Barometer Capital Management. So very appropriate that that last title, Diane, that you're joining us here today. One of the, I think, interesting things for me after reading the Michael Lewis book, reading a lot of other things, is I think there's a sense that people don't understand actually how a trade works. So that's where we'd like to start. You sitting on your desk when you put in a trade, take us through the steps of it.
Sure. So you get a trade, you have to do something, whether you get it from your portfolio managers and several orders. You, first and foremost, from an institutional order perspective, a retail trader will have his or her TD Waterhouse account or their personal account that they trade in. But from an institutional buy-side perspective, you choose your avenue, your highway to go through, your broker. You then make a decision how you want to handle that order. It depends on so many things. It depends on the market situation, how the market's behaving today, on the volatility of the stock, what the price range is, what the bid ask is, and then you put in your order through your highway. It has to be a broker-dealer. You chose your broker. So now you have to decide, how is it going to be sliced up? Is it going to go into an algorithm? If so, what kind of algorithm? Is it going to have a limit? What kind of limit? I recommend limits at all times. And then it goes. Then your fills start coming back. Whether it comes back in 100-share increments or whether it comes back in 1,000-share increments, it kind of starts coming back in different variations of price. And within the limit, and hopefully you chose the right way, and hopefully you thought it out well.
As an institutional investor, do you choose that highway yourself? You say, I want it filled, I'm going to send it to the broker, and after the broker takes it, do you have any hands-on to where that trade goes once it leaves the broker?
You sure do. You have, you can take a human, this is I think where it all kind of, we need to separate this. You can't take the human element out of this, because even when you go out there and you connect with your broker and you decide what algo and what limit, you still have to have your eyes on this. You still have to have your judgment on it. You still have to see how it impacts the market based on the liquidity or on the kind of algo that they're using. Or maybe it's not an algo.
Maybe you keep using this term just to algorithm. What do you mean by using an algorithm?
So we can decide, do we want to put it into an electronic mathematical algorithm that will slice up based on number of shares, say 100 shares every few minutes at a particular price within a particular limit? Do we want to be a percentage of volume? Do we want to bid only? Do we want to always take the offer when there is a particular number of shares? There's so many ways. There's hundreds of order types. There's hundreds of algorithms. And we can talk, I can talk about this for hours. There's so much to say.
So there's so many things going on. Where and how does somebody see your order? And I think that is at the heart of the Michael Lewis book.
Right. So there could be inflammatory type of comments and say that market's rigged. And then there is the other side that says, we've gone from 12.5 cents or 25-cent spreads to a penny. Is that penny really a spread? Where do they see my orders? So you don't know who you're interacting with. A lot of this is just a lot of thought who you're interacting with. The high-frequency traders, there's so many different kinds. There's predatory, there's legitimate market making, there is ETF arb. You're interacting with all of these. Now, I will tell you that I've been trading since '95. The quote definitely is a little more opaque. It is a little bit more moving. But don't forget, it's a penny. So it moves a penny, it goes down a penny, it goes up a penny. So
where moving an eighth was a lot more difficult before they went to pennies.
12.5 cents,
yeah.
25 cents. They wouldn't show your order if it was in the middle. This is what the regulation originally started out with. Brokers being told to show their clients' orders even if it tightened the spread. And this is what started tightening, and then the decimalization. But there's a lot of people that trade vis-a-vis my order.
I guess two questions. Do you believe that you, as head of trading at Barometer Capital, are being picked off and losing money on each individual trade because of what's going on around you?
I think the bottom line is that you cannot take smart out of trading. Before, you had to make the right call. Today, you have to make the right call. You have to tap the market and see what impact you're making when you start trading. You have to go to the right...
So not show your 100,000 share order.
You do not. And you do not. And electronic trading has a lot to do with the volatility because, for example, if somebody makes the wrong decision and puts out an electronic order in, say, an illiquid stock, and there's other algos that are connected, say, to volume, and you do the wrong thing, those other algorithms come with you. So percentage of volume algorithms, for example, those are algorithms that require you to catch up on volume, has less price sensitivity. If the stock is thin and somebody puts up a block, say a cross, those algorithms will need to catch up on that volume and it will really impact the price. Trader took his eye off. Happens in his absence of 2 minutes. All of a sudden the price moves. So lots of things.
Should an individual investor, a retail investor, be worried?
I don't think so. I think that it's easier to trade today when you have 100 shares to buy or 1,000 shares to buy. I think that the block trading that we used to do has become more difficult. Block trading is only 11% of today's volume. Price and risk pricing in the market for large blocks has become different. But you can always buy 100 or 1,000 shares at a penny spread usually.
Okay, thank you very much. Diana Avigdor, Vice President, Portfolio Manager, and Head of Trading at Barometer Capital Management. We're just looking at some of the exchanges that exist in Canada and the US, a lot more than you might have thought.